Hello and a very warm welcome to Money Control's special budget edition. I am Shweta Punj. In a series of conversations with thought leaders, economists, policymakers, we are trying to unbox the Indian economy for you, trying to make sense of a very complicated world and really trying to break down the context in which this budget will be presented. Joining me today on the show is Mr. Sajjid Chinoy. He's joining us from Mumbai. He's the head of Asia Economic Research at JP Morgan. Hi, Sajjid. Thanks so much for joining us. Delighted to have
Hi,
you here.
Shweta. Good to be here.
It's our pleasure. Before we begin, I'll just set a little bit of a context for our viewers and for our listeners who are tuning in. Why are we having this discussion? We are having this discussion because India will present its budget on the 1st of February. And there has been a huge change in the narrative of the India story from the first half of 2024 until now in 2025, early 2025. Globally, the world has changed. You have a new president in the United States, Mr. Donald Trump, who has really he's almost set a cat amongst the pigeons in terms of the policies that he's promising to implement, including higher tariffs for countries like India. That's one part of it. Second part of it is the domestic context where India is battling a consumption crisis, it's battling an investment crisis. So all of that put together, we are having this discussion because politically speaking, Sajid, this is it's a huge vote of confidence for the Modi government. They're presenting their first budget in their third term, which in itself is a tall order, and it comes right after we've seen a huge global shift with a new president in the United States, who has been Mr. Trump has not held back when it comes to really pitching what he believes should be the new global order. He's completely resetting the economic model for America, which will have implications for the world. It's end of globalization as we've known it. So, let's begin with the global context. How concerned should India be about what we are hearing from Mr. Trump, and how does that complicate our budget making exercise?
Thanks, Shweta. Great place to start. I think it's first important to disentangle what these global forces are, because there are two forces and they tend to get conflated. The first is, even before Mr. Trump, or what the world grappled with in 2024 was this concept of US exceptionalism, where the US economy continued to do better and better than what anyone thought. Most people had predicted the US going into recession in sometime 23 or definitely in 24. Exactly the opposite happened. Not only did the US escape recession, but it was growing very strongly. Now, why does this matter? It matters because growth differentials around the world determine exchange rates. So what we saw was, because the US was doing so well, Europe had stagnated, China was under pressure. The dollar has been extremely strong over the last 6 months, and that has put sustained pressure on emerging market currencies, including the rupee. The second reason was that strong US growth made the last mile of disinflation in the US much harder. And so expectations that the Fed would be cutting interest rates dramatically in 2025 have been allayed. And you now have a situation where markets have gone from 5 Fed cuts to just 1 cut or less than that. So that has meant that apart from the dollar being stronger, US yields are higher. In other words, global financial conditions have remained elevated and tight, right? And that's put pressure on emerging market currencies even before Mr. Trump. Now, I think, in a Trump 2.0 presidency, it's hard to tell what will actually happen because there are so many moving parts. I think the one thing we can say with certainty, or with some degree of confidence, is that uncertainty is going to rise. And we saw that in Trump 1.0, that when there are concerns about policies being changed every day, every week, every month, businesses tend to retrench, and businesses don't like uncertainty. So around the world, we saw in Trump 1.0 that global sentiment slowed, both business and consumer sentiment. Global capex slowed. So one, element that India will have to grapple with is it's possible that the continued uncertainty in the global environment will slow global growth, and that has
Yeah.
implications for India's exports in the coming years. So I think
Right.
the challenge for emerging markets is such that number one, you could be dealing with slower growth if there's continued uncertainty in the global economy. On the other hand, if US exceptionalism continues, that US
Hmm.
growth, because you could be in a funny situation, Shweta, where growth around the world slows, but US growth slows less than the rest of the world because
Right.
US tariffs will hurt US growth,
Right.
deportations and immigration curbs will hurt US growth, but there could be offsets in the US economy because what Mr. Trump
Hmm.
has always also promised is a lot of deregulation, which will help
Hmm.
corporate business investment in the US and more
Hmm.
fiscal easing. So you're in this very
Right.
strange dynamic where global growth is slowing, US growth is
Hmm.
slowing less than that, which means US exceptionalism continues. And then emerging
Hmm.
markets have the worst of all worlds where you're dealing with lower global growth, but you're still dealing with tight global financial conditions. One last thing I'll say in
Hmm.
all of this is China, because the
Yeah.
starting conditions in China are very different this time than in 2018. China is sitting on a lot of excess capacity across multiple sectors. If the US China get into a trade war, the concern for countries in Asia and other emerging markets is that more and
Hmm.
more of this excess capacity gets redirected to those economies, and that has an
Yeah.
implication for manufacturing. So my point is there are lots of moving pieces. This could be a tricky and volatile year for
Yeah.
emerging markets. India will have to be very vigilant.
Right, absolutely. So, Trump's promise of make America great again, and the fact that there could be massive deregulation and maybe lowered corporate taxation for American companies or for companies worldwide. How does that impact India, Sajid? Because we have been talking about Make in India. We've got production linked incentive schemes. We want FDI to come into our country. We've been trying to take advantage of China plus one. So, I have been speaking with economists and thought leaders who've been saying that this needs to be like a 1991 like budget if we want to bend on the opportunity, right? And if we have to tide over this challenge that Mr. Trump is posing for India. How do you see the implication? How do you see this playing out? In the Indian budget, do you think there is room for corporate tax rate cuts? Do you think that there is room to enable for measures to be introduced to enable more FDI to come into the country? There's room for more deregulation. Should this budget be used as a statement that the Modi government makes to the world, like a pitch to the world that okay, we are open for business and come to India and invest.
This is a unique opportunity for India. As you said, it's the first budget of a third government, and so there's more political capital. But
Hmm.
also, near term, the world will be a dangerous place because of all the factors we discussed. But medium term, this opens up a lot of opportunities. Yes, the US would like companies to come and manufacture back in the US. But remember, the reason why companies are not in the US right now is because it's cheaper and more efficient to manufacture outside, to manufacture in a China or in India or in Indonesia. So,
Right.
if you do have a situation where tariffs are imposed in some countries, my sense is the first impulse of companies will be to look for other lower cost, efficient locations before you go
Hmm.
back to the US, which is much higher cost and you could lose your competitive advantage. So India should basically expect that in the coming years, that there will be a lot of opportunities. There's going to be a lot of churn of global value chains. And if you do get into a protracted US China trade war, then you will have multinational companies that look for other places outside of China, and India will very much be in that shortlist. And B, you
Hmm.
will have Chinese FDI looking for other homes in the region. So there are
Right.
lots of opportunities that will open up from this. Now, what can India do? I think India
Hmm.
has to project itself as being ready, waiting, and willing. And I think this is
Hmm.
where the July budget was really important because that really was the first budget, and an intent statement was made, and the finance minister spoke about the lead motif was employment linked incentives, but the finance minister
Hmm.
spoke about the importance of structural reform and working with the states. Spoke about coming out with an economic policy framework document to guide the vision for the coming years. There were very important rationalizations of import tariffs. For the first time in many years, tariffs were brought down. And remember, the foundational theory of trade theory is an import tariff is like an export tax. So when you're
Right.
bringing import tariffs down, you're actually sending a strong signal that you want to promote exports. There was talk
Hmm.
about reimagining India's financial sector architecture, making the income tax code easier, revisiting basic customs duty. So there were a lot of very important starts made. And so
Hmm.
what I'll be looking for in this budget really is what happens on all of those areas. Now, of course, these are long-standing projects, but which of
Right.
these are we taking ahead?
Hmm.
What plans are being made to operationalize and execute and implement some of these initiatives? I think we
Right.
need to be realistic on the fiscal math. I'll end with that, Shweta,
Yeah.
that we are in a consolidation stage, right? Fiscal deficits have to come down because public debt has gapped up, and in fact, public debt has been inching up the last couple of years. So
Hmm.
deficits have to come down. We can debate what the pace of consolidation has to be, but you'll have to see some fiscal consolidation, which means that fiscal space is constrained, that there are
Hmm.
limited degrees of freedom on that front. So really, I
Hmm.
think the stimulus, so to speak, will have to come from reforms outside of the
Hmm.
fiscal math.
Okay, so let me quickly go over some of the domestic challenges that we are facing. One is an evident urban consumption crisis, something that has been, voiced by a whole lot of FMCG companies. We are seeing a slight uptick in rural consumption, but that's not enough. So that's one. Second is private investment has not picked up. That continues to be a matter of concern. FDI into the country has continued to fall, and I was talking to Dr. Surjit Bhalla yesterday, who told me that if you look at disposable income of middle class Indians, it's actually gone down in the last few years. So, what, according to you, are the levers that this budget needs to accelerate on, and they have to, and accelerate with complete focus, because when it comes to PLI, the whole idea was to increase manufacturing, to increase investment. We've seen success in that, but it's not been to the degree one would have hoped for. We've seen certain sectors that have worked out very well under PLI, but it's not led to an increased share in manufacturing, or whether it's exports or even as a percentage of GDP. So what are the levers that we need to accelerate on to increase GDP? So
So I think it's important to diagnose, what you mentioned. Why has urban consumption slowed? Why has investment not
mm,
picked up? I think the private investment story is, I think, a more straightforward story because, and I've had this view for several years now, that the good news is the supply side has been cleaned up. We've seen deleveraging, private sector balance sheets are very healthy, cash levels are high. But you have to understand the psyche of entrepreneurs. When
mm,
utilization rates are about 75%, which they've been more or less in the last few years, and you've got a lot of imports from China. If you look at India-China bilateral trade deficit, it's close to the highs we've seen over the last decade. So a lot of imports
mm,
coming in. In that environment where you're competing with these cheap imports and utilization is 75%, you do need more demand visibility. It's when you have the demand
mm,
visibility that you will make investments. Now, a lot of this has to do with animal spirits as well. And here we live in a very integrated economy. So the fact that there is all this global uncertainty under Trump 2.0 and there's so much churn will weigh on corporate sentiment around the world, not just in India. So I think the key for us to stoke a private investment cycle is to deliver more demand visibility. Now, to the government's credit, it's been focusing very hard on public investment. Central government public capex has almost doubled. It's gone from
yeah,
1.7% of GDP to 3.2. It's important
right.
that we don't let up momentum on that front, that we continue. I know
Mm,
there are limited degrees of freedom, but we need to continue on that path so that you provide some demand visibility. Now, this is where urban consumption becomes important because urban consumption was the key driver of growth in the first 2 or 3 years. But some slowdown was inevitable, and I'll tell you why. What was driving urban
mm,
consumption? There were three factors in my mind. One was you had a lot of excess financial savings from the pandemic. And this happened around the world, that people had made these savings in those 2, 3 years and they were running it down. Those savings have largely been extinguished. The RBI data a year ago says that those savings will run down. Secondly, if you look at formal sector wage growth, If you look at 3,500 listed companies, those wages are running at 15%. That has now slowed to about 9 to 10%. So there's been some slowdown over there. And then some consumption was being financed by unsecured lending, right? And
Hmm.
that was unsustainable because you worried about problems in that area. So I think the RBI correctly tightened the screws, 15 months ago when it raised risk weights for unsecured lending, and that's come off. So from an urban consumption perspective, if the stock of savings has been exhausted, wages at the margin are slowing, and you've seen some tightening in macroprudential measures, it stands to reason that urban consumption would slow. It should not be a surprise. Stepping back, Shweta, I think the larger issue really is employment and jobs. That
Yeah.
consumption over a 5-year period is going to track incomes and therefore job creation. And
Hmm.
therefore, I think the measures that were started in the budget in July were important because there was a signal here that we want to make India's growth more labor intensive. I've been saying this for many years. If you look at annual survey of industries data,
Yeah.
capital intensity in manufacturing has continued to
Hmm.
increase. Now it's increased around the world, but for a
Hmm.
young country like India to get very
Hmm.
capital intensive growth is a challenge. So we have to make growth
Hmm.
more labor intensive. Now, what does this
Right.
mean? I would say that if we're doing PLIs, it should be in labor-intensive sectors, right? And we want to make significant investments in human capital, health, and education to make our population employable. So, if you ask me,
Right.
the one set of measures has to be how do we make growth more labor-intensive? There were
Hmm.
important starts that were made in the July budget, but we need to take that now to its logical conclusion.
So, Sajid, one question that comes to my mind is when you're talking about making growth more labor intensive, making manufacturing more labor intensive, as we bring in more technology, as we bring in more sophisticated equipment, which is what we are seeing in infrastructure, for instance, road building, right? It's
Yes.
mostly being done by machines, and you need skilled people to ride those machines or to operate those machines, and it's no longer what it used to be. And my worry, for instance, is that while we are talking about our demographic dividend, focus on education and skilling has not kept pace. When it comes to the AI story, we are we are looking at the United States, we're looking at what's come out of China, but where India is concerned, India has not even made a start. So, in the AI space, I'm sure a lot of startups operating in the space will not like to hear this, but it is a fact, right? It's a fact when it comes to innovation, and so I'm just trying to understand that when it comes to modernizing an economy and creating jobs for a country where there is a majority of the population that is blue collar, how do you balance it out? The government brought out an apprenticeship scheme in the last budget where it directed companies to hire people as interns. Now that seems like too much interference from the state at a level, right? I mean, you're telling companies that whether they need it or not, you need to hire interns because you need to create jobs, you need to be able to ensure that there's some sort of the youth is gainfully employed. Is that the right way to go about it, Sajid? What kind of messaging is that giving out? And any examples from how other countries have managed? So China managed it at a different time. Now now the global context is completely changed.
It has, but you see, jobs are never easy, and they're going to take 1,000 small steps. So I think we should
Mm,
try everything possible to boost jobs. Now, it's undoubtedly the case that manufacturing has become more automated, more capital intensive, but there are still some labor intensive sectors. And what you want is, every day entrepreneurs are making a choice between capital and labor because to some
sure.
degree there is substitutability in some of these sectors. And what you want to do is to ensure that that is a fair choice. Now, what do I mean by that? That the state and society is doing everything possible to give labor the best chance. And that means much more education, much more skilling. We have to make our workforce more employable. And if it means,
Hmm.
better educational standards, more skilling, more internships, it's going to take 1,000 small steps. It's going to take a village to do this. So I think, and
Hmm.
it's not just one, that's the supply side that we need. That what can we do to keep working on our education policy, health policy, skilling policy? on the demand side, are there certain laws that are tipping the scales in favor of using more capital intensive techniques? If you've got labor laws and the perceived cost of labor is getting higher because there are some frictions, can we do things to
Hmm.
rationalize that? If the state is going to give incentives and use industrial policy, can we redirect those towards labor intensive sectors? The good news
Okay.
is China has pivoted hard. Given China's demography, it's understandable. They've pivoted hard towards capital intensive sectors. So they're doing,
Hmm.
AI, solar panels, electric vehicles, right? But what they're doing in that process is they've given up a lot of space in the traditional, more labor intensive, lower
Hmm.
manufacturing sectors. That space is vacant. India should be seeking to occupy that space,
Hmm.
right? So I
Hmm.
think I think the July budget made an important start in recognizing that we need to
Yeah.
make more growth more employment intensive, and there are a
Hmm.
thousand different measures, supply side, demand side, regulatory, that we need, and that's going to be a work in progress. So I think that has to be the overarching policy objective in the next decade. How do we make our growth more labor intensive
Okay.
during our
Okay.
demographic transition? One last thing I'll say, Shweta, the next 10 years is really important because that's
Hmm.
when our demographic transition peaks. In Asia,
Right.
44% of their per capita income growth between 1960 and 1990 was attributable to the demographic transition.
Hmm.
So it's been those decades where people have this opportunity that they've really been able to press the accelerator on growth. And therefore, the next 10, 15 years becomes really important for us to exploit that demographic transition.
Hmm. All right. So, is there a case for tax rate cuts, which is it's an idea that's been doing the rounds that the middle class needs a break, income tax rates need to be nationalized, and that could boost consumption. Do you subscribe to that school of thought, or do you think it's going to have a very limited impact, and there are other ways of boosting urban consumption?
I'll say that I think the first recognition is that fiscal space is constrained because deficits have to come down. I think that's the first, we have to be
Hmm.
cognizant of that reality, that the deficit this year could
Hmm.
be 4.9 or 4.8. It has to go down to 4.4. Now, what you don't want to do is compromise on the critical investments that any economy needs. We've begun on infrastructure. We should not let that go because we're seeing less of
Hmm.
that at the state level the last few months. So the center has to keep going on infrastructure. We just spoke about the importance about health, education, and skilling budgets. Budgets itself may not be a sufficient condition, but they will be a necessary condition. So if you've got all these important investments to make and you've got deficits to come down, something has to give. Now, it's possible that that I mean some have asked, markets are asking for a targeted tax cut, but I think if you're stepping back, it's also important to realize that fiscal multipliers are larger on the expenditure side than on the revenue side. So if you want to help someone give the economy, then giving tax cuts, which can be some of which is
Okay.
saved, not all of it is spent. But again, these are judgments that have to be made.
Do you worry, you, Sajid, that our competitive federalism is getting replaced by competitive populism? You look at the state elections. We saw what happened in Maharashtra, Haryana, and now Delhi. This is only last year, and at the start of this year, Delhi elections. We're in the completely just a week away now from Delhi elections. Everything is being offered for free. Do you think this sets a template for the central budget also? Do you think that this could, we are reaching a point where we might be uh, leaning towards offering more freebies to boost consumption?
Well, I think there has to be a recognition here that there is no free lunch and that there's an opportunity cost of expenditures. What was important last year was that the center's public investment was complemented by the state. So if you look at fiscal year 23-24, you saw a big
Hmm.
push by the states on infrastructure. Capital expenditure went from 2.4% to 2.9%, right? This year, what we've seen in the first 8 or 9 months of the year is that the quality of state expenditure has deteriorated in the sense that we've seen subsidies and revenue expenditures go up at the cost of capital expenditures. I think there
Right.
has to be a recognition at the state level that state fiscal deficits are close to their 3% cap. Now, when you're
Hmm.
close to your cap and you're increasing some form of subsidies, I'm not saying all subsidies are not warranted. Targeted subsidies are important at the bottom of the pyramid, but we have to be very cognizant here that there's an opportunity cost to this. It
Hmm.
could today it's going to be public investment. In the months and years to come, it may well be the investments we require in health and education. So for me, those are the critical investments we have to make in the next decade. Physical
Hmm.
infrastructure, social infrastructure, making our economy more competitive, right? And so it's important that those priorities not get undermined by competitive populism.
Okay. All right. So towards the end of this conversation, very quickly, Sajid, your three big, asks from this budget, the three things that you'd like to see the finance minister address.
Yeah, I mean, I will answer those, but it's a bit unfair because these are complex times, and I think
Yeah, yeah.
there are multiple objectives that the finance minister is going to pursue. I think before I give you three things, I think the challenge for India in 2025 is how do you respond to the domestic growth slowdown without appearing to lower your guard to a hostile
Yeah.
global environment? That's the single challenge. Now, what are the three things? We've covered them. I think continuing with this employment theme that was started in July and extending it beyond incentives to PLI schemes for labor intensive sectors, and more importantly a focus on health and education to make labor more employable. I think this whole package on human capital augmentation and employment is crucial, number one. Number two, the finance minister did speak about working with the states on factor market reforms. That was really important part of the speech. And we spoke about the global context here, that as companies look at India and they're shortlist to relocate here, we have to give the impression that we're ready, willing, and waiting, and make the business environment here extremely competitive. So I think for me, those are the two big themes that need to work. I know markets will look closely at the fiscal framework. The government has
Hmm.
said that from this year on, fiscal deficits will be calibrated to a declining debt to GDP ratio. If this is a declining combined debt to GDP ratio, that's exactly right. So I think those are the three things one would look for in terms of big picture here. That what is the fiscal framework going forward to preserve macro stability? What is the roadmap for structural reforms in the first budget of the third government? And what are we doing
Hmm.
to make growth more labor intensive?
Okay. At the start of the conversation, you mentioned that you're expecting a general slowdown to continue, especially in the emerging markets. What's your outlook for India for the current fiscal and for the next fiscal? Any projections that you're
Shweta,
working with?
there's just so much uncertainty at this point in time because we don't know how the global economy is going to evolve, and I think that's going to have a bearing on all emerging markets. What I will say is that even as fiscal policy is consolidating, monetary policy will have some space to respond to a slowing economy. We've already seen that. We've seen in the last few days, in the last few weeks, the exchange rate has become more flexible and has depreciated, which is an easing of monetary conditions. We've seen the central
Hmm.
bank has injected a lot of durable liquidity. Inflation is coming off, which is really good news, and that should help both purchasing power. We think headline CPI will average 4.5% the next 3 to 6 months. That means there's relief on purchasing power and space opens up for monetary easing. So there are lots of moving parts here in the near term, but I think the
Hmm.
key is if India has to, grow at 6 to 7% or higher in the next decade, which is our aspiration, it will have to be on the back of persistent structural reform.
All right. Okay. Thank you so much, Sajid. We hope to connect with you post budget to get a sense from you on, what you made of this crucial financial statement. A big thank you to all our viewers and to all our listeners for tuning in. And of course, we'll keep getting you more on what the budget could look like and the state of the Indian economy right here on Money Control. Keep watching the space and do send us your thoughts and feedback in the comment section below. Thank you.